Your LLC is not protecting you right now. Most LLC owners unknowingly make at least 3 of these 7 mistakes, and even one of them can cost you your personal savings, your home, and everything you have built. I have been a business attorney for more than 20 years, and I have sat across from hundreds of small business owners who believed their LLC was bulletproof, right up until a lawsuit arrived or the IRS came knocking. Number 3 on this list is the mistake I see most often, and it is operating silently inside businesses at this very moment. Stay to the end, because every item here has a specific fix you can implement today. Mistake number 1. You formed your LLC, but you never signed an operating agreement. This is the single most common and most dangerous gap across every state where LLCs are filed. Without an operating agreement, your state's default rules govern your company, and those rules were written for generic situations that almost certainly do not match your business. An operating agreement is the private rulebook for your entire company. It defines who owns what percentage, how decisions get made, what happens when a partner wants to exit, and how profits are split. Without one, a business partner, a disgruntled investor, or even a family member with a financial stake can drag you into court, and the judge has nothing to reference except state default law that was not written with your business in mind. Research consistently shows that the overwhelming majority of LLC legal disputes involve businesses that never formalized their internal rules on paper. A basic operating agreement drafted by a business attorney typically costs between $300 and $800. A one-time expense that can prevent disputes costing 10 times that amount in legal fees alone. If you have been putting this off, it is the first action you should take after this video ends. Mistake number 2 is one that good-intentioned business owners commit every single day without realizing they are quietly dismantling the one legal protection their LLC was designed to provide. It is called piercing the corporate veil, and it happens more frequently than most business attorneys care to admit. Your LLC is legally treated as a separate entity from you as an individual. That is the entire point of forming one. But the moment you use your business bank account to pay for personal groceries, a personal cell phone bill, or a family vacation, you blur that legal separation. Courts look at this pattern and conclude you are not truly operating a separate business, which means your personal bank account, your home, and your personal savings become fair game in a lawsuit. Business attorneys who handle LLC disputes are specifically trained to look for this pattern during the discovery phase of litigation. They will pull every line of your bank statements going back years. One personal Amazon purchase, one personal Uber trip, one dinner that was not a legitimate business meal. These are the breadcrumbs that support the argument that your LLC is essentially a fiction. The fix is simple and non-negotiable. Open a dedicated business checking account and never allow the two worlds to touch. Mistake number 3. Not paying your quarterly estimated taxes. Most LLC owners know they owe taxes in April. What they do not realize is that the IRS expects 4 payments throughout the year, spaced roughly 3 months apart. Skip them, and you will owe an underpayment penalty even if you pay every dollar you owe by the April 15th deadline. These 4 payment dates are not optional suggestions. They are legal obligations for anyone who is self-employed, operates a single-member LLC, or receives distributions from a partnership or S-corporation. The IRS underpayment penalty currently runs at an annualized rate of 7 to 8%, calculated separately on each missed installment. If your income is in the 6 figures, skipping a single quarter can cost several $100s in penalties on top of the tax you already owe. The most reliable system is this. Every time a client pays you, immediately move 25 to 30% of that payment into a tax savings account you do not touch for any other purpose. Then pay your quarterly installment on the dates on your calendar. This habit takes less than 60 seconds to implement and eliminates one of the most common, most frustrating, and most entirely avoidable IRS penalties that small business owners face year after year. We are at the halfway point, and I want to speak to you directly. These are not theoretical risks that lawyers debate in conference rooms. These are real patterns that produce real court judgments, real IRS assessments, and real financial consequences for business owners who believe they were protected. The next 4 mistakes are just as serious, and at least one of them applies to almost every LLC owner watching this right now. Mistake number 4. Forming your LLC in the wrong state. You have seen the advertisements. Register your LLC in Delaware, Wyoming, or Nevada and gain tax advantages. These states do carry real structural benefits for specific situations. But if you live and operate in California and form your LLC in Wyoming, you are not escaping California, you are adding Wyoming on top of it. Forming in Wyoming while operating in California means you must register in California as a foreign LLC, pay California's $800 minimum franchise tax annually, comply with California law, and simultaneously maintain Wyoming's requirements. You are not choosing between the two states, you are paying for both. The out-of-state strategy creates a genuine advantage only in specific contexts. Multi-state operations, significant net worth asset protection planning, or businesses structured for outside investment. For the vast majority of small business owners who live in one state and operate in one state, forming your LLC where you actually do business is simpler, cheaper, and legally cleaner. Dual registered agent fees, 2 sets of annual reports, and multi-state compliance requirements can easily cost more each year than any perceived benefit from the out-of-state structure. Before paying extra to form in another state, ask your CPA to model both scenarios. The numbers often tell a very different story than the advertisements. Mistake number 5. Ignoring your LLC's annual compliance requirements. Your LLC is not a one-time setup. It requires maintenance every single year without exception. Most states require an annual report, a renewal fee, and an active registered agent on file. Fall behind on any of these, and your state has the authority to administratively dissolve your LLC without notifying you first. Every single LLC in the United States has a set of annual obligations that vary by state. Some states use the anniversary of your filing date as the deadline, others use a fixed calendar date. Many states send a courtesy notice, but not all of them do. By the time you discover your LLC has been dissolved, it may have been inactive for months. During that gap, contracts you signed and liabilities you incurred may be treated by courts as your personal obligations, not your company's. Reinstatement is possible in most states, but it comes with back fees, late penalties, and in complex cases, attorney costs to untangle liability questions from the dissolution gap period. The prevention is almost absurdly inexpensive by comparison. Set a recurring calendar reminder 90 days before your state's annual report deadline, assign it to someone specific in your organization, and treat it with the same urgency you give a tax filing. Mistake number 6 is specific to LLC owners who have elected S-corporation tax treatment, one of the most powerful and legitimate tax reduction strategies available to small business owners. The mistake is failing to pay yourself a reasonable salary, and the IRS is specifically trained and highly motivated to find it. When your LLC is taxed as an S-corp, you receive income 2 ways: a W-2 salary and an owner distribution. Self-employment tax, currently 15.3%, applies only to your salary, not to your distributions. The obvious temptation is to minimize the salary and take the bulk of your income as distributions to reduce that tax exposure. The IRS is fully aware of this strategy, and it is one of the most consistent audit triggers among S-corp filers. The IRS evaluates your industry, your annual revenue, your role in the company, and comparable market salaries when determining what reasonable means in your specific case. If your business generates $150,000 in profit and you pay yourself $18,000 in salary, that is a highly visible red flag with a predictable outcome. Work with a CPA who has direct experience with S-corp payroll compliance to set your salary at a level that is both tax efficient and defensible. Mistake number 7 catches even experienced LLC owners by surprise. Signing business contracts in your personal name instead of as your LLC. Your company may be perfectly formed, fully compliant, properly capitalized, and operating with a thorough operating agreement, and one incorrectly signed document can draw you personally into a lawsuit that should have been your company's liability alone. When you sign a contract without your LLC name and your title in the signature block, courts have consistently held that you signed it as a private individual. Your LLC had no legal role in that agreement. This applies to commercial leases, vendor contracts, client service agreements, loan documents, independent contractor arrangements, and partnership deals. Every single one must carry your LLC's full legal name and your title within the company to preserve the corporate shield. Before you sign any contract on behalf of your business, run through this 5-point check. It takes under 60 seconds and protects everything you have worked to build. The signature block correction alone has saved clients of mine from personal judgments in the tens of thousands of dollars. These are not bureaucratic technicalities. They are the exact mechanisms by which your legal protection either holds under pressure or quietly fails the moment it is needed most. 7 mistakes. Any single one of them can collapse the legal protection you spent time and money building when you formed your LLC. The good news is that every item on this list is fixable. None of them require starting over, and most of them can be addressed this week with the right professionals alongside you. The businesses that survive legal challenges and IRS scrutiny are not necessarily the ones with the most money. They are the ones that built their legal foundation correctly and maintained it every year without exception. If this video revealed a gap in your LLC setup, subscribe. We publish videos exactly like this every week covering business law, tax strategy, and the legal tools that protect real business owners. Drop your state and your most pressing LLC question in the comments below, and our team reads every single one. Your business is worth protecting correctly. Do not let one of these 7 mistakes be the reason it is not.